Howdy, Jacob here. Today we're looking at the company American Software in the software industry. 343 million market cap on 264 million enterprise value. So it's a pretty small company. Let's see what their insider ownership, just 1.38%. So not a lot of insider ownership. They do pay a dividend, haven't increased that in a while. But on a yield standpoint, you're looking at about a 4% yield. So a pretty hefty dividend. And you can see that, it's been more than their earnings per share since 2017. So their payout is over 100%. Not a positive sign there. Return on invested capital in the averaging upper single digits with operating margin down, but gross margin up. So let's see if that's because R&D. Okay, so they are spending a bit more on R&D, which is, the goal of research and development is for prospective growth, not necessarily today, but basically investing today to get growth in the future. And so for that to double, not a terrible sign, but it's still, their operating profit is down. Net income is relatively flat. Share count is up. Balance sheet looks good though. 114 million cash-like products with zero short-term debt, zero long-term debt, 56 all of their liabilities. So they have enough cash to write off everything. They don't have any interest-bearing debt outside of, capital lease is pretty much zero. So yeah, really no interest-bearing debt. And free cash flow, very little capital expenditures, good production of free cash flow from cash flow operations. And they're just sending it all out in the dividend. The good news is the free cash flow is greater than their earnings. So we saw on an earnings per share level, it was lower than what their dividend payout was per share. But on the free cash flow basis, it's still like a 75% payout ratio, but it's not, they're not paying more than what they can afford and going into debt to do so. They haven't gone into debt at all. So they definitely can't afford this dividend, but they're limiting their ability to reinvest, make acquisitions, buy back shares with the heavy payout for a dividend. So again, there's 5 things you do with your free cash flow. You can make acquisitions, reinvest back in yourself, buy back shares, pay down debt, which they don't have, pay a dividend. And they're just doing it all in a dividend, really. And recently made 2 large net acquisitions, but outside of that, from 2018 to 2022, just paying a dividend. And so let's make some assumptions here. It's not going to be sexy. I'm going to do the classic 313, basically saying grow with the market, a little bit less than the market, terminal at the end of 7 years. I do love that free cash flow is so much higher. It will do pretty big range here, 10, 15. Share change. Do they have stock-based compensation? A little bit, 5 million. That's about one. Let's do 1%. Keep it light and airy. So it still needs to drop 62% given these assumptions right here. And that dividend, I don't want to raise it because they haven't for the last 7 years, 6 years, and it's already 75% of the free cash flow. As a company this small in the software industry, I feel like there's a lot more growth ahead of them or possible growth in their sector. I just don't know whether this company is going to be taking a lot of it from what I'm seeing in the numbers. So interesting company, just not at the right price for me. I think I'd want this at a pretty darn cheap price. So hopefully you enjoy the video. Have a great day. Thank you.